Good morning, I'm Chad Justice, and welcome to Market Monday for May 25th, 2026. Happy Memorial Day. Memorial Day marks the beginning of the busiest travel season, which historically means more gas demand and higher prices. So, what happens when supply is already being crunched? Last week, I left you with a question. With more than 10% of the world's oil supply offline and inventories draining at a record pace, why isn't oil higher? The answer is the prices are already being managed. And to understand how, you need to understand how oil trades. Oil doesn't have a single set price. Instead, it trades as a series of prices stretching years into the future. And there's a price for a barrel delivered next month, a price 6 months out, and a price 2 years out. Stack all those prices together and you get what we call a futures curve. The front of that curve, the near-term price, reacts to what's happening right now, and the rest of the curve reflects the market's future expectations. Right now, the curve is backwardation, meaning the near-term price sits above the long-term prices. And that shape tells you that the oil market is tight today, but relief is expected down the road. Future oil prices expect the strait to reopen and the barrels to come back online. And then the front of the curve, the near-term price of oil, is the most sensitive to the headlines. Here's why that matters. Every time a leader suggests the conflict is winding down, traders price in returning supply, and the near-term price gets pushed lower. The oil price is being talked down in real time. That's jawboning, the practice of moving a market with statements rather than actions, and it's been working. Now let's look further out on the curve at the prices a year or two from today. The oil is still priced for a quick return to normal. Oil producers don't make decisions based on next month's price, and new supply requires capital commitments, new wells, and projections based on where prices sit years out. Lower forward prices tell every oil producer that this spike is temporary. Oil producers crave stability and predictable numbers above almost everything else. So if the future cash flow math doesn't make sense, oil producers won't build out new supply. Higher oil prices are the only force that can force oil producers to add supply, which would rebalance the market and ease oil prices. Instead, they're forced to sit on their hands, waiting for clarity that hasn't arrived yet. Meanwhile, the commercial and strategic oil inventories continue to draw down at historical paces. This week, the Energy Information Administration reported the largest weekly crude oil drawdown on record, close to 18 million barrels. Surely this astonishing figure sent oil prices surging, right? Not quite. What's remarkable is roughly 15 minutes before that record draw was reported, the president told the press the war was in its final stages. The most bullish inventory number we've ever seen landed in the same window as the most bearish headline available. That headline alone dropped oil over 3%, completely disconnected from physical realities. That's been the cycle since the war started. The physical oil market is tightening at a record pace, while the paper oil prices are being held in check by the expectations, set daily by news sources that this is going to end soon. As long as the market believes the words, the front of the curve stays capped and inventories continue emptying. The risk here is simple. If the words stop working or the reopening doesn't come, the market will be forced to price in shortages. That's the asymmetry that we've been watching, and it's why real assets keep coming up in our conversations. If you want to talk through what this means for your plan, reach out and we'll get you on the calendar. And if you know someone who would benefit from this discussion, forward this their way. That's all we have for you today. As always, thank you for watching this week's edition of Market Monday. Join us again next Monday for more of the insights that matter for your money.